Good afternoon. I'm John Mitson, the Menard Family Director of the Sheila and Robert Challey Institute for Global Innovation and Growth. This afternoon, I'd like to introduce you to David Hong. David is an Associate Professor of Accounting at ndsu and a Faculty Fellow in the Challey Institute. Welcome, David.
Thank you, John. I'm so glad to be here.
It's great to have you here. You do some very interesting research related to corporate tax cuts and the effect of corporate tax cuts. What kinds of questions do you aim to tackle with your research?
Well, I'm working to investigate whether the Tax Cuts and Jobs Act has effectively stimulated the investment in tangible assets, such as land, building, equipment, machinery, all these. And another question related to that is, what's the impact of the TCJA on intangible assets, such as the research and the development of new patents and products?
Great. And so when you talk about the Tax Cuts and Jobs Act, you're talking about the tax cut that occurred in 2017,
Yes,
correct?
That's 2017 TCJA, Tax Cuts and Jobs Act.
Right. So do you have any preliminary findings about the impacts that this might have on investment at all?
Yeah, we found something very interesting. This TCJA has made the most complicated tax changes in over decades. It changed the corporate tax rate, the individual tax rate, in many ways. So far, we found out that some of the tax cuts, tax changes are working well in stimulating investment. For example, by lowering the corporate tax rate from 35% to 21%, lots of firms, they invest more in these property, plant, and equipment, these type of assets. However, some of these tax changes doesn't work at all. For example, there is a 100% bonus depreciation option for firms right now after this 2017 TCJA. However, we found out no evidence that this new tax change has promoted investment in tangible assets at all. Meanwhile, we also found out something very interesting is that the new requirement of amortizing and deducting research and development expenses over 5 to 15 years has a negative impact to investment. In the past 60 years, we allow firms to deduct this R&D cost immediately from taxable income. The new tax laws require them to amortize all these R&D costs over 15 to 15 years. That long period. So the firms responded by decreasing their R&D expenses to save their tax money. So actually, this tax change is working against the growth of our economy. Based on all these findings, we would suggest the policy makers to reconsider all of these tax changes. Maybe it's not necessary to give this 100% bonus depreciation option to firms at all because it doesn't work, right? In addition, more importantly, we would suggest they reconsider this amortization requirement of R&D costs because it works against our economy. So it's better to completely remove this amortization requirement for our capitalization and amortization requirement of our R&D costs.
Very interesting. So you're talking about the various details of the tax change. And a lot of times people just frame it as a tax cut and they look at just one aspect of it, but you're talking about the kind of counteracting effects.
We need to know that all these. We need to know all these details. Then we can better revise our tax laws to stimulate the economic growth.
Right. And so you've talked a little bit about the importance of your research right now. Could you just talk a little bit more about how your research impacts society?
because of these findings, one thing is we would suggest the policymakers to change all these tax laws. Another thing is we can help all these investors better understand those financial reports, which part of tax changes would work well. Then they would expect the changes in firms' performance. It helps them to make better decisions when they select all these stocks. Because this tax change doesn't have all these unanimous impact to all these firms. Some firms benefit from these tax changes. Some of them don't have any benefit at all. So they even lose money. Okay? So our research helps the investors make better decisions, have the allocation of those resources in the capital market.
Excellent. And so are there additional questions that you'd like to tackle in the future related to this area?
Well, that's a good question. In the future, I would like to work on issues related to cryptocurrencies. You know, the market value of cryptocurrencies is about $2.5 trillion now. And 16% of Americans say they have either invested or traded or used cryptocurrency. So there's a huge market there. However, our current accounting standards require us to recognize cryptocurrencies as intangible assets. That means that there is a bias in financial reporting. We can only recognize the impairment loss of cryptocurrency investment, but we cannot recognize any gain there. That means investors, they cannot understand the value of cryptocurrencies by reading our financial report. If they cannot understand the value of our financial report, they cannot make the right decision. The capital market will not be efficient. So there is a significant impact to our economy, to all the investors. If I can find more solid evidence, I would suggest the Financial Accounting Standards Board to revise the accounting standards so that it can help the investors better understand the value of our business.
Yeah, excellent. That's an interesting aspect of cryptocurrency, I think, that a lot of people haven't thought of. It's something that a lot of people don't understand other than they see, Bitcoin skyrocketing and they don't really understand.
No, there's downturns of cryptocurrencies.
Yeah. So this has been very interesting. Thanks for taking the time, David, to sit down with me. It's been very interesting.
It's my pleasure to be here.
Yeah, thank you very much.
Thank you.